welcome to the Capital Discussions Roundtable. This is Tom Nunemaker, and our guest today is Amy Meissner. Before we get started, we have a disclaimer. The Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, let me stop sharing my screen. And for those of you who don't know Amy, Amy is a good friend. I've known her for a long time. And she's a great trader, written up in, was it Technical Analysis of Stocks and Commodities magazine as the queen of the Iron Condor a few years ago. And Amy, if you want to maybe say a few words about yourself for the people who are just seeing you for the first time.
Sure. Basically, I've been dabbling in, well, not dabbling, I trade full-time options since 2006, but I started getting involved in options trading in the mid-90s and kind of made it my full-time job, I should say, if you can call it a job, in late 2005, 2006, and have been basically trading high probability strategies, option strategies in the indexes, and enjoying, some pretty good consistent returns over the years. So a couple of my favorite trades have been the nested Iron Condor. I'm not sure if you guys have heard of that version of it, that I guess somebody in the community named it the nested Iron Condor, one of the types of strategies I like to do, and also the Weirdor, which is what I'm going to talk about today, or my version of it. And I guess that's a little bit about me. So if there isn't any questions, I can, somebody had actually asked me, last time you mentioned a nested Condor was, actually, I'm not, this particular presentation role is going to be actually on the Weirdor, my latest Weirdor, but I am planning on coming back and doing a nested Condor presentation soon, so I'll just have to schedule that with Tom, so there will be one. Great, so with that, I guess I'll get started. Just a little bit of background, a little bit on the Weirdor. I just want to say that it's basically, the Weirdor is kind of a variant of the Iron Condor, so it's still kind of in that family, but the adjustments and are dealt a little bit differently. It's kind of a more flatter T+0 line. Try to keep the losses a little bit smaller than an Iron Condor, so it tends to be a more smooth ride. And I did do a pretty detailed presentation on it. When was that, Tom? A few weeks ago or something? It should be in the library, in the Capital Discussions library.
Yeah, I'll look up the date.
Okay. So that's something that you guys could watch, where I kind of went over a little bit more detail of the guidelines and so forth of that. So I'm not sure if there's a lot of people that were in that, or that watched that presentation, or also back to watch this one. So today, what Tom had asked me to do is just show my latest Weirdor trade, which would be the February expiration trade, which is still on, but it's getting close to being taken off for hopefully a nice profit. So far, it's a nice profit right now. So if there's no questions, I'm going to share my desktop and kind of go through that trade for you guys, and hopefully you'll get something out of it.
Yeah, no questions. And your Weirdor presentation was on the 20th of November, and you did a nested Condor strategy one in August last year.
Yeah, I think the nested Condor strategy one that I did was more of a just kind of an overview of how my previous, or that year, went for the nested Condor. It wasn't as much of a detailed WebEx, but I'm planning on coming back and talking a little more detail about the nested Iron Condor in the future, so look out for that one. So anyway, I'm going to share my desktop, and okay, does that look like it's mine?
Yep, we see it. Yep, we see it.
Okay, cool. So what I'm going to do is I'm using a program called OptionNet Explorer, which is something I'm sure a lot of you have heard of. It's just an options analysis program that allows you to look at the graph and the position concurrently, and very similar to OptionView, which I'm sure a lot of you are familiar with as well. Basically, the Weirdor trade, I like to start it anywhere from 40 to 55 days to expiration. That seems to be a good sweet spot. And I like to try to, if I'm, you can't always plan these things perfectly, but I like to try to get it into a Weirdor trade on a down move, especially if it was a nice big down move, because the volatility pop kind of gives you a little more premium in the options that you're selling. So in this particular case, I'm going to go to the price chart and just kind of show that the market at the time, and this, by the way, is in the Russell 2000, which is my preferred index for trading the Weirdor, although it can be traded in the other indexes like the SPX, the NDX, and also some like maybe larger stocks that have a decent amount of volatility and a high enough price. Certainly, everything must be pretty liquid to trade, but the SPX is also, and the NDX are also very good candidates for this particular trade. But I generally trade it in the Russell 2000, and so that's what I'm showing you today. So this is basically, this is a live trade that I have on right now. It's still on, but I started it in January on the 6th, on Tuesday. And as you can see here on the graph, and I don't know if my screen is delayed, but I'm just highlighting with my arrow, hopefully it's not delayed, the area of the graph where the Russell 2000 had been coming down. It had gone up, to the all-time highs of the Russell 2000, and then it kind of petered out and started coming down. It was a nice little down move for the week prior. And that's when I prefer to get into these trades, because you get that, like I said, that nice volatility pop. So if that happens, it's a great opportunity for me to get in. In this particular case, for this particular account is a Reg T account that I trade. I also trade a portfolio margin account and another Reg T account as well, but smaller. But this one, I like to do a 4-tranche Weirdor. That in this particular case I ended up scaling into over a couple of days. And so I think I explained in the Weirdor presentation that I did before with capital discussions that the Weirdor is kind of made up of 4 pieces. The main income comes from a put credit spread, and then there's additional income that comes from a call credit spread that could come from a call credit spread, but there's not as many pieces to it. And then there's additional protection on the downside with a put debit spread and some additional extra puts that are way out of the money that I put way down here. So basically, if I was to look at a 1-tranche Weirdor, it would be made up of 10 put credit spreads to 1 put debit spread, to 2 call credit spreads, and then 1 additional put somewhere way out of the money to kind of balance it all out and get a pretty decent flat-ish T plus line. So in this particular case, I was going, yes?
Yeah, there was a question if you could show the deltas in your matrix.
The deltas are right here. You can't see that on the
Oh, yeah,
bottom?
you can see the position deltas.
Oh, I see. You see. The deltas here. Got it. Is that what you mean?
Yep.
Perfect. Okay. So in this particular case, I was, in this account, I generally do about 4 tranches or units or whatever you want to call it. And because the market had had a pretty nice down move after this big up move, I thought, okay, let's just put on half of it today, on this particular day, and then see what happens in the next day or two, whether it bounces back up or continues to go down. I'll put on the, scale into the other half so that it can kind of balance out the position as a whole. So that's what I did with this. So I got it into half of it. So that's why you can see 20. So everything was multiplied by 2, so a single tranche multiplied by 2. So so by the time everything was said, so basically just as a quick review, the put credit spreads are going to be under a 16 delta at where the short is going to be under a 16 delta. The put debit spread is going to be anywhere from 10 to 15 points below the money. In this particular case, it could be up to 20 points. There was no 5, the in-between strikes. I like to use the 10s mostly, but I will use the 5s as well on the Russell. And in this particular case, so it could be basically anywhere from 10 to 20 points. Generally, I usually do 10 to 15 points out of the money, but I kind of play around with that to try to just flatten out the delta as much as possible and get a decent premium out of it. And then on the calls, I like to do a 12, or the short of the call is going to be 12 or under on the delta. And then for the additional put, I'll play around with that just to try to flatten out this left side of the graph. A lot of times I'll come in closer, and instead of doing it here, usually it's like $4 or $5 actually is what it ends up to be. But because of the big down move and the volatility pop, it was a little more expensive, so I actually put it further out of the money. But a lot of times I'll put it up here, and it'll flatten out. As you can see, that would have flattened out the curve a little bit more, but it was pretty expensive, so I ended up putting it down below a little bit further in this case.
I had a couple questions.
Sure.
What kind of credit do you want from your put and call credit spreads, and do you have a minimum acceptable credit?
Well, I probably wouldn't go under like $1.50 for the put credit spread, or $1.55. Usually, at least $1.60, $1.65 for that. Usually more. And for the call credit spread, sometimes I'll do $1.30 or $1.20, but sometimes I'll go all the way up to $1.90. It just depends on what I definitely look at the deltas, and I definitely look at the position as a whole to try to flatten out the T+0 line. But I'm going to definitely be a 12 delta or less on the call short, and a 16 delta or less, preferably much less than the 16. Definitely don't want to be over a 16 delta on the put shorts, is where I kind of start looking at things. And then I can move my calls and puts accordingly, as well as my put debit spread. That gives me a lot of protection on the downside, and kind of play around with what looks the best. In this particular case, because of the big down move and because of the big volatility pop, I was able to get 20 points away on the, and still have some decent protection on the put debit spread, and get my short put, under a 14 delta. So it really, if the market had been moving up, it would look a little bit differently. I might have to be a little closer as far as a little higher delta on the short put, and I might not get as much premium because the volatility isn't quite there. There's not as much premium in it. So it's kind of like a game of, especially, and this is with all positions, when you get into a position, when you're making adjustments, you got to make your adjustments. You just got to do it. You got to take whatever price, that you can get to make the adjustment so that the trade stays out of trouble and you manage your risk. But when you get into a trade and put on a position, I have plenty of time to, see what's going to give me the best bang for my buck, so to speak. Nobody's forcing me to do anything, so I'm going to take my time and try to figure out where to place those things, which positions or which strikes are going to give me the best position that I, for what I'm looking for. With that said, though, I do like to be at least 5% out of the money on the calls, but that's, with 45 days to go, I probably want to be more than that, more like 7 or percent or more. And on the puts, I like to be at least 7% out of the money on the puts, but with the big down move, I want to get even more, which I was able to here. So I think this is like 8 or 9% out of the money, which is much more comfortable. But when we had the market going up all the time and we had the lower volatility, I wasn't able to get as far out of the money as I would have liked. But I do like to keep it within a certain range. I'm not going to, just to get a certain premium, I'm not going to make this thing so tight that I'm not, I still want to make it a high probability trade. So in essence, I'm really working on making sure that this is a high probability trade in the 80+% probability of making money by the end of the trade. So is what my goal is. Did you have a question, Tom?
Yeah, is this what we're looking at? Is this one tranche or is this two tranches?
This is two. So I think I mentioned at the beginning, this trade was set up, this particular account, I was going for 4 tranches. And because of the down move, I decided to scale into it. So I did 2 tranches on this day. And then a couple days later, I put on the other 2 tranches. And it just happened to be on the same strike. So that's why you see 20 here. Normally it would be 10 put credit spreads, 1 put debit spread, 2 call credit spreads, and then 1 extra put somewhere way out of the money. In this case, everything is just multiplied by 2.
The typical margin for one tranche would be in the $15,000 to say $18,000 range?
Yeah, exactly. So if I were to change this and just put in 1 tranche, get rid of that, and just put in 1 tranche, you're looking at I have to do a separate, sorry, about 17,000. 18,000 is probably the minimum I would want to have in an account with 1 tranche in a Russell 2000. These are all, by the way, I didn't mention this before, but these are all 20-point wide spreads. But, to be safe and to have a little bit of money on the side, 20,000 is something that I would prefer with a single tranche, but 18,000 you can get away with something like that, but 20,000 would be better. And the nice thing about the Weirdor, as opposed to the nested condor that I do, is that the margin pretty much stays the same throughout the trade. There's no, there's no rolling and increasing contract size on the put side that will increase your margin. And, purchasing debit spreads is the only thing that you would need to have a little bit of money to purchase, but your margin is basically going to be lowered because you're purchasing debit spreads. So it's pretty much the same throughout the trade, which is nice.
So that's a pretty fair statement to say that that's about the max margin you would use. You don't need a lot of extra margin.
Right, exactly. You don't need a lot of extra margin. But it's always nice to have a little cushion in case of whatever. 20, just rounded up 20,000. I feel pretty comfortable with that on a single tranche Russell 2000 Weirdor. So with that, the first thing I like to do is, so I put on this trade, and then I like, my days to expiration as far as exiting is my goal is to try to get to about 14 days to expiration, which in this particular program I can do by just looking here, 14 days to expiration, clicking on that date, which is the, what does it say, the 6th of February. So that's basically the Friday 2 weeks before the Friday of expiration. And it kind of gives me an idea of what I'm shooting for. So I'm shooting for about 7%. In this case, $2,500. A single tranche would be about half, about $1,200. And that would be if I didn't make any adjustments at all. So I know that that's not necessarily realistic. I'm probably going to make some adjustments on any trade in a given month. It's very rare that there's no adjustments. There's at least one. So I'm happy with like 3 or 4% on these. And then occasionally I might keep it till the following Monday, and then what happens, you'll see sometimes, is the T+0 line at that point goes above the expiration line, and the sweet spot is going to be around in here. But as you know, if I'm sure all of you have been trading for a while, it's very hard to get into the sweet spot no matter where it is. You usually fall outside of it, or if you're there for a day, you might not be there the next day. So, but it happens. And there's been times where I've actually been here and just had enough wiggle room on each side to stay in the trade longer because it wasn't going to affect my profit and loss whether it went up or down a good amount. and was able to collect more theta as the days went by and actually take it to like a week to expiration or even a few days. But I like to get out of it 14 days to expiration because there's you can always, at that point there, you can work with the trade, you can get out of it. There's, once you get too close to expiration, it's really difficult to make any adjustments or anything that you might need to make if there's some, big move in one direction or another that might not be something that you can handle, or the trade can handle. So with that, I'm going to continue forward with this trade. Basically, I entered the trade. The Russell was at 1161. And at that point, I just kind of looked at, I'm not going to defend my calls very much. That's why there's not very many of them. One of the keys to this particular trade is that if you've been trading options for a long time, the market tends to move up about 75% of the time, and there's more call adjustments than there's put adjustments, or adjustments for upside moves, I should say, than for downside moves, even though the downside moves tend to be scarier and sharper. The upside moves tend to be the ones that happen more often. So this trade was kind of came about to handle that type of move, but still keeping in mind and managing the risk that a big downside move can make. So I don't like to. So basically, because of that, the calls are not really defended all that much. They're on, and then I kind of watch and see, based on original price here, I kind of look to see, well, if I'm down about 1.5%, or sorry, 1.5 times, I take off half, and then if it's down about 1 3/4 times the amount of the credit, I'll take off the other half, and then I might move them up, and I might not, depending on what's going on in the market. But I'm not going to defend them that much, and I'll still be able to make money in the trade by doing that. If the downside is generally defended by additional put debit spreads, and then if it keeps going down, and I put on a few tranches of put debit spreads, and it continues to go down, then I can start taking off some of the credit spreads, which will take out the potential profit of the trade, but it really flattens out this T+0 line, and in some cases, the trade could be doing very poorly, or really the Russell could be down quite a lot, and you can still end up making money or even breaking even on a trade that looks like it would normally be pretty scary if it was an Iron Condor and you had to keep rolling down. So okay, so
a couple people asked if you tried without the puts, or why trade the calls at all?
Because it flattens out. Without the calls, the oops, let me do separate. Nope, I got to do combined. Sorry. Without the calls, it just, you just, your delta is going to be a lot more. You're looking for a directional trade without the calls, and with the calls, you're flattening out the T+0 line and looking at it more as a very balanced trade. So it's just to balance it out, just to keep the delta neutral. So the point of this trade is to try to keep the delta in a reasonable range. So if it goes up, as it goes up or down, the market goes up or down, you're not making a lot of money, you're not losing a lot of money, but you really start to make money as the theta starts kicking in, and you just want to stay in this trade until 14 days to expiration. So my goal is to try to stay in the trade until that date and try to collect as much of that theta as possible without getting into trouble. And that, it also, it generally keeps the losses smaller than, it's not going to be, trying to keep the losses at a break even or a 1% or a 2% loss, as opposed to the same amount of money as you would lose, or that you would, that I would, if I'm going for 4% a month, I'm going to try to keep my losses no more than 2 or 3%, so they're lower than the amount that I'm trying to make, as opposed to some other high probability trades where, I'm willing to take a loss of 1.5 times or 2 times what I'm trying to make. So it's just a little bit different. Just makes for a smoother, projection of profits over time. So I better get going on the rest of this trade. I'm never going to get past the day one. Okay, so January 6th. So I'm going to go to the end of the day and just go forward to Wednesday. Nothing really was going on there. As you can see, the it's just staying pretty flat delta. On the next day, there was a pretty big, had been going, remember I got into this trade at 1161, so there's been a pretty big up move. So first thing in the morning, I had a contingent order on, and my calls just started, hit my trigger point for taking off half of my calls and not, because I don't want to defend them. And so half of them came off at that point, making my delta flat again. And then about 45 minutes later or so, the other half came off. So as you can see, the price got even, the market moved up a little bit more. The price got a little bit higher, hit my other trigger point, and all of a sudden I don't have any calls anymore. So now I've kind of got this. Now if I go to 14 days out, I still have a chance of making some good money on this trade. But there's some different things that I can do. I can look and see, what do I, technically, like, where are we? Are we overbought? Are we still, looking like there's, some pretty decent upward momentum going on with this trade, where I might just let it ride for a little bit and see if it, if it continues to go up here, I might end up taking it off and repositioning the whole trade and just taking a small profit. Or is it something where we're at an overbought, or I feel that, obviously I don't have a crystal ball, but I feel maybe we're a little overbought, and I feel safe to add back the credit spreads at a higher strike price. So I have some options, and it kind of depends on what's going on and what I feel, or what's going on with the Russell. And of course, those are all kind of trader's choice options. But taking that into account, I also haven't entered my third and fourth tranches of this trade yet. So because I haven't done that, when I put that on, it should balance out the trade as a whole position, and then I'll look at it, even though there'll be different strikes. If I put on my next third and fourth tranche and complete the 4 tranches that I want to do and scale into it now, it's going to balance this out and then allow me to look at the position as a whole, as opposed to just a separate, completely separate Weirdor without what's already, without the position that's already in place. So that's kind of what happened. So in this particular case, it gets a little confusing when you do it that way, but in this particular case, I ended up putting on the third and fourth tranche at completely different strike prices, because the market has moved from 1161, even though it's only been 2 days, all the way to 1194. So it's moved quite a bit in that time. So now I put on 2 additional tranches, but they are at a much higher. Let me change this back to delta. The delta is still, under 16 for the put credit spreads, but the strike price is a lot higher than my original strike price. These are at 1090. My original one just 2 days ago was at 1040. And then I put on my put debit spread, and as you can see here in this particular case, I've done something a little bit different. I put the same amount of, 2 tranches of the put credit spread and 2 tranches of the additional put debit, or put down below it out of the money. But my calls, instead of just doing 4, I was able to play around a little bit, because now I'm, looking at it as a whole position with what I had on before, and I was able to just get away with putting on 1 of the put debit spreads, where normally if it was 2 tranches I'd have 2, and adding back the 4 that I sold up a little bit higher at the 1270 to kind of see if I can get back some of that credit potential that I lost, and still have a nice balanced flat trade. And so I played around with it, and that's what I decided to do, is to try to make it a trade where I could gain back some of that money that I lost on the calls without adding so much risk to it. So now if I go 14 days to expiration, I'm back at like at 6%, looking for 6% at this point. Of course, I don't think I'll get that, because I'll probably have some adjustments, but that's what I'm shooting for. So continuing on, let's see. Actually, what ended up happening in this particular case, end of the day, was I never had to make additional adjustments, but it's kind of a little tricky at this point. So let me go through this. Let's see. So on the 9th, so at this point, I'm kind of looking at this going, okay, I had some, I was watching it down below, like at what point do I need to put on an additional put debit spread. And because I added these two new tranches, I kind of came up with a different reference point. So my original reference point was, I believe, 1175. I was able to change it, make it lower, and put it down to like 1172. And then I was able to keep lowering it as time went by because of, where the trade was and where I felt the Russell 2000 was. So what ended up happening was I kept changing I was able to change my alert for when I was going to put on additional debit spread protection lower and lower as the days went by till it got to the 13th. And at that point, at 1172, oops, on the 13th, excuse me, one point during this day, there we go. We had quite a bit of, went from being up quite a bit to coming down, and I added an additional put debit spread to flatten it out again. And in this particular case, when I'm adding a debit spread as protection, I want to put it, either somewhere at the money or 10% below the money, so it actually has a good effect. In this particular case, I didn't want to step on any of the other put debit spreads that I had, so normally I would put, I would just see, like, do I need 2 of these? Do I need 1 of them? What do I need to make this flatter? And in this particular case, since I didn't want to step on this, it was at 1170, I think it was at 1171 when I actually put it on. There's no 65, and 60 was already being used as a, I would have canceled that out. So I ended up having to put it on the 1170, which made it possible for me to only have to add 1. So I kind of played around with that and added the protection without it. See if it was a little bit. I put that on closer to about here, and then about it, I was starting to, get down, get down to a little bit of a loss, and it was starting to look like this T+0 line was going to start, going down at a steeper rate. So I added that in, and it just kind of flattened it out a little bit, just, so that I had a little bit more wiggle room. And then I also added another trigger point so that if it continued to move down, I would do another debit spread. And that particular trigger point ended up moving each day down to what I felt comfortable with, which ended up to be 1150. And the reason for that was because, and you don't see it in this chart, you do here actually, the 11, well, in my sink or swim charts, here's a 200-day moving average on that day, on the 13th. It was at about 1148, and usually we get a bounce at a 200-day moving average, so I thought, okay, let's put this at 1170, or 1150, excuse me, and add another put debit spread if we get to 1150 and see if we bounce. And if we bounce, great, I just put on some extra protection. It cost me some money, but it's, flattening things out. And if we don't, then, it's extra protection, and then I can decide what to do, either add more or start to remove some of the put credit spreads. Just, keeping the trade out of trouble. But still, able to make a good profit. So here it's now with the extra protection that I put on, still able to make about 5%, potentially. And then it never got down to that point. It got very close, but it never got down. I think it got to 1151. And then snapped back up. And we also had the 3-day weekend, which was is also a kind of a blessing because, you know, Theta is going to come out of this trade and help out as well and kind of move that T+0 line up. So that helped as well. So by the time Tuesday rolled around, Tuesday morning, let me go back to Tuesday morning, things have stabilized. And as you can see, this T+0 line, where it was down lower on the Friday before, has just kind of completely moved up. So if I can go back, and if I were to jump to Tuesday, you can, you know, that's a theoretical price, but you can see in reality, oops, it just kind of pops up. So if you notice that the whole T+0 line popped up. It kept me out of trouble, kept me from having to spend more money on a debit spread that I might not have needed. And basically, we've been stabilizing. Well, we've been kind of choppy, but stabilizing enough to get some good data starting to come into the trade now that we're below 30 days to expiration. And today, see if it'll let me go to today. You know, it's up 3%. My goal is to get to 14 days to expiration. And I still have the opportunity to make, you know, a decent amount of money, but, you know, 5% on this trade in, oh, I don't know what it would have been, 30 days. I think I put it on at 45 days to expiration and get out 14 days to expiration, something like that. So that's kind of, that's the latest one. That's my February trade, and hopefully this will work out. I've only got a week and a half left, and I've got some good wiggle room in either direction. So Delta's pretty almost completely flat at this point, and my theta keeps rising. So that's kind of the name of the game. Just keep, you know, give yourself some room on either side, and, you know, capture theta as long as you can. Stay out of trouble. So anyway, any questions?
Well, we did have some more questions. Jack Lane asked, are you concerned with gamma?
Yes, gamma really starts to take effect, especially as you get the closer to expiration that you get. That's one of the reasons why I don't like getting too close to expiration. You know, within 2 weeks, it really starts to make a big effect. But I'm not really concerned with it at the beginning, you know, for most of the trade. Unless I get down, like unless for some reason, and every once in a while this happens, I'll get into a sweet spot like where I've got a lot of room on either side and I can stay in another day and another day and another day. That's happened to me, I think, twice in the year and a half I've been trading the Weirdor. Then, you know, once it gets beyond that sweet spot, it's just not worth it to stay in because the gamma starts, you know, you start to, this little curve, the T+0 starts to, it's not as flat. It can, you know, really take some of your profits out and get you in trouble. And then there's really nothing you can do when you're only, you know, once you're within, you know, let's say 10 days to expiration, there's really nothing you can do within that monthly cycle. Oops. You'd have to roll the trade to another monthly cycle or just, you know, take less profit than you have or something. So, so yeah, so that's one of the reasons why I don't like to wait too long to take these off.
Now you have an exit rule that you exit 14 days before expiration. Do you have a max loss, like on the downside, for instance?
I don't really have a max loss. What ends up happening is as I'm putting these debit spreads on, I think the worst that's ever, what usually happens is, let's say there's a big down move. I add another debit spread, and then it keeps going down, and then I add another debit spread, and it keeps going down. I'm either going to add another debit spread at that point, at the third, adjustment point, or start taking off some of the credit spreads, which of course takes potential profit out of the trade. But it really, what ends up happening as that's going on, let me see if I can show that. Let's see. No, that doesn't really show it. Well, because this is only showing today's date. If I already had it on, what ends up happening, let's just see if I can emulate what it would look like at least. That's too much. Well, what ends up happening, in this case, it's already, we're so far into the trade. Let me go back in time. It would be easier to explain it or show it, I guess. Let's see if I go back here. There we go. It'll look more like what I'm trying to show. Okay. So let me take that off. As I'm adding these debit spreads and then possibly taking off some of these credit spreads, if it continues to move, because there's only so many times I can add debit spreads before it, gets too close to these credit spreads to where I'm getting a little nervous, and then I really want to take out some of them, okay, I had another two of those. You'll see that the T plus 0 line starts to come up like that. It starts to, flatten out over here, so it's just, there's less and less risk. And at a certain point, you can actually see the graph. Oh, it's too much. There you go. But at a certain point, the graph will actually start looking more like this, where it's just not that much of a loss. So yeah, I would take it off if it was too close. And in some cases, now I don't think I've ever seen it, but there has been some cases where this T plus 0 line kind of comes up like this. You can see my cursor. Depends on where it starts. But as I said, I think, if I was way over here and I did everything I could to make this trade work, and we were just not bouncing, we were just continuing to go down and down and down, then I probably would say, okay, look, I'm trying to make at least 3 to 4% on these trades. I really don't want to be down more than, let's say, 2 or 3%. So if I was really close to the short strike of my put credit spread, I'm getting really close to that, and I did everything I could already, then I would probably just take it off at that point, So, and then that would just be like kind of a personal preference. It's like, do you want to let it ride a little bit longer, or do you want to, but I don't have a set rule. I'm just going to try to do everything I can to try to flatten this out so I'm keeping myself out of trouble. And then I'm going to decide at that point, well, it's not worth it to stay in because I think we're going to continue to go down, or I think we might get a bounce, and then I might just take it off even on a small bounce. So it's kind of like a trader rule, not a hard rule. Of course, I would never want to get beyond this, the short strike. That's definitely a no-no. I would never want to get beyond there. I would definitely take it off in that case. But hopefully I've flattened out this T plus 0 line enough to where it's still not going to be a horrible loss at that point.
And we did have a couple of questions about like delta to theta limits or position deltas. Do you monitor any of those?
Yeah, I do. I don't want, for a single tranche, I kind of, a 25 delta, a positive 25 delta. I don't want to really, that's when I really want to do something, especially on the upside or the downside. So I try to keep it within a 25 delta for each tranche. And then it's like at that point I really want, want to make sure I do something. Most of the time something's done a little bit before that.
And then
But
Bob
you can
Hogg.
multiply that, so for 4 it would be like 100.
Okay. And Bob Hogg asked, do you like this trade better than the nested high prob Iron Condor? If so, why? It seems like a lot more work.
It's definitely a lot more work. It has pluses and minuses. It's kind of like, it would be nice to, you know, if I had enough, or whatever, if anybody, whatever, if you had enough money in the account, I would prefer to do both. Because the nested Iron Condor, it's very margin intensive. You start off at a really small margin, but you have to leave room for a much larger margin just in case you have to roll and get out of the way. So for the same amount of margin that you know you're going to have a constant, you don't have to worry about that as much. So that in that respect, the Weirdor is nice. The nested Condor doesn't have as many adjustments, or they're a lot easier, and there's not as much trader's choice possibilities where you really have to think about, well, what's going to be the best thing for this trade in a nested Condor than there is in the Weirdor. So in that respect, the nested Condor is nice. But the Weirdor has more of a smooth profit line. I like the way it uses margin better. I think, you know, for a Condor, let's say you're going for a 5 or 6% profit each month, then, you know, a loss, I'm allowing like 1.5, maximum 2 times, but generally the maximum loss is a 1.5 time loss on a nested Condor. On the Weirdor, I'm working on making my loss smaller than the gains that I make, so it's a much smoother graph throughout the year as I go along. You know, there's not as big of a hit if there is a loss, and it tends to deal, you know, manage the risk a lot better as far as that's concerned, because obviously the T+0 line's a lot flatter on a Weirdor than it is a nested Condor. But you know, on the other side, on nested Condor, when the you know, unless you have really high volatility, and you know it really does well in a choppy market, whereas a Weirdor won't do very tough in a really choppy market, which we have had, but it generally does pretty well in all markets. Whereas the Condor, you know, if it's got really low volatility and you're just heading in one direction all the time, when we were doing that like all through 2013, it was really difficult to make a decent percentage. It was like very low percentages, you know, where it used to be like 5 or 6 or 7% a month in the higher volatility time, you know, it's dropping down to like more like 2 or, you know, 3 at the most or something. So the Weirdor kind of was basically doing about 4, you know, anywhere from 3 to 5% average all the time, no matter what the market was. It doesn't like the super choppy stuff as much, but it's doable. So, you know, it has its pros and its cons. I like both of them, and I think as a combination, they both kind of complement each other. So.
And then a couple more questions about where you put on or take off your debit spreads.
Well, I always start with 1, and it's generally about 10 to 15%, or 10 to 15 points out of the money on a Russell 2000 from where I start. And then when I have to add debit spreads, like on an adjustment, it's generally somewhere between, you know, it could be at the money or 5 points down or 10 points down. Generally somewhere between, you know, no more than 10 points down on an adjustment. It can be different. It really depends on, you know, I don't want, number one, I don't want to step on something else that I had. And, you know, I want to make sure that I'm handling my delta. So I'm going to look at, you know, what's going to give me the best bang for the buck. You know, I want to do, if I spend this much on this put debit spread, is it, you know, what is my graph looking like? Is it helping my delta enough? That kind of thing. But generally, that's where it ends up falling for that, for a debit spread. And then occasionally, like especially on a portfolio margin, because the margin works a lot differently, not with a Reg T, but with a portfolio margin, a lot of times I'll go in and I'll buy a weekly put to deal with margin. But that's totally another thing. And these are a lot more easier to understand when I just do a single tranche. Then the rules become a lot more, the guidelines are a lot easier to follow on a single tranche than it is when you start multiplying the tranches and then scaling in over time and having different strike prices. Then it starts to get a little bit more confusing. Like this one might have been a little confusing because of the way it was, but a single tranche Weirdor is a lot more easier to follow, and the guidelines are, you kind of stick to the guidelines a little bit more closely.
So one question, standard deviations at all, or just the 10% range?
I'm sorry, what?
Robert asked, do you use standard deviations or the 10% range?
I actually like to use the average true range. I use a standard deviation as, you know, like if I have a 1 standard deviation move, generally it's about the same as the average true range, 14 days. But lately we've had some pretty big chops, so I like to use the average true range for my, you know, to kind of guesstimate approximately where I would want an alert, especially when I first put on the trade. Once the trade's been on for a while, then I start to just look at, well, what would happen, you know, if, you know, I move my cursor down here theoretically, where am I going to be? Do I really need to add protection there or not? You know, am I falling off a cliff? Am I still profitable? You know, how do I want to spend my money? You know, how many days left are in the trade? Where's the best use of that money? So that's why in this particular trade, as each day went by, and we had a 3-day weekend coming up, even though the market kept moving down at that point, I kept moving my alert down for the puts because I don't want to put on an adjustment if it's not really needed. You know, I only want to put it on when it's really needed because it does cost money, and I don't want to. You can take them off as you get as I get closer to expiration or exit, I should say. I might take off, like, you know, maybe a week and a half or 1 week to expiration. If I had already put on a couple of extra put debit spreads, I might just start peel them off to flatten out, you know, my T+0 line. But you got to be careful with that because sometimes the market will chop around and then, you know, be in trouble again. So I try to be pretty careful with how I spend my money on the put debit spreads, but I do want to make sure that I, you know, manage the risk too. I don't want to get crazy and leave myself open to, like, let's say being down here and then all of a sudden my, you know, T+0 line's starting to fall off a cliff and I put myself in a bad position. So I hope
Kevin, he said some Weirdor traders widen the put debit spread. Do you feel stepping on existing put debit spreads causes problems?
Yeah, that's another thing that I do as well. And it's just one of those things where I'll go in, I'll go, okay, I'm getting close to my my adjustment trigger. What do I want to do? And I'll just start, you know, theoretically putting in debit spreads. Do I want 2 here? Do I want 1 here? Do I want a, you know, a 40-point wide or a 20? What's going to give me the best bang for the buck? And, you know, that kind of thing. So you just kind of see what's going to do the best. And some of the ways I do that is let's say I'll put it in, like, let's say I put this in here to add another one. I also, one of the things I'll do is I'll go and see, well, how does that look at expiration? Is it really doing anything for me? Or if I decide, okay, I've only got a week and a half to go, I put on 3 adjustments down here, you know, do I really need these? Can I get some of my money back? You know, what does it do for me today? Is it putting me too much risk? And how much, by doing that, where am I going to be at my target exit date? Is it really helping me all that much? So I generally do that with any adjustment that I make. Other than, you know, just taking off the calls pretty quick, those are contingent orders. I'll definitely go into the put debit spreads and kind of see, like, well, how is it going to affect me now, and how is it going to affect me on my target exit date? Is it the right decision? No matter what it is, if it's a 40-point wide or a 20-point wide, or you know, the number of contracts, if it's closer to the money or further away, that kind of thing.
Okay, one more question. When the market whipsaws, do you take off some of the put debit spreads when you seem to be over hedging?
No, I will if I'm getting really close to my exit date and my graph's looking pretty good. But I'm not going to do it, you know, if I still had another week to go or 2 weeks to go in this, you know, if it was like a week or 2 before and I had already put on all these put debit spreads, I'll leave them on. until I start to get much closer to, like maybe about like now, if I had already done like 2 adjustments on the put side, I might think of like that last one that I did. I might start thinking about taking it off this week to capture some of the money back without losing any more, because it's losing money. Because especially as you whipsaw and the way the markets have been lately, taking some of those off a little too early can basically all it does is just keep draining the trade of money. So that's again, I'll look to see, does it make sense to do that? Like this one, should I take this off? What's it going to do for me today? What's it going to do for me at time of expiration? Is it worth the risk? Is it really gaining me much? Because I'm not staying in until 0 days, so I'm not even bothering looking at the this line, the expiration line. So that's the way I judge of when I'm going to do that. But I usually don't. I wouldn't even attempt to do it too soon, only because I don't have a crystal ball, and the way the markets have been lately, they just keep chopping around. It could be up 20 points today and down 30 points tomorrow, and that put debit spread could have been useful at that point. And I don't want to put it on, take it off, put it on because it's losing money.
So when you add your put debit spreads, does the call side ever go below 0? And if it does, how do you raise it back up if you need to?
The call side ever go below 0 when I add my put debit? Oh, yeah, that's a possibility, especially if it happens early on in the trade. Let's say I have to, that's a possibility where this right side of the graph can go below 0. But in that case, it's best to just look at, what's my target date. Generally, the target date will be above the 0 line. I think, where was that in the trade? I think if I go back to the morning of the 8th when I just had the first 2 tranches on, back, here we go. This is just, remember when I only had the first 2 tranches and both all the calls ended up getting triggered to be taken off, and you can see this expiration line. It didn't drop below the 0 line. It could have if I had put an additional put debit, if I was really whipsaw. But it dropped quite a bit lower than it was. But a lot of times if this drops below 0, this T plus 0 line at the time of trade exit will still be above the 0 line. It's kind of like, that's why I always check that. I always see where am I at in the trade now, and where would it be at, how is my position looking at my target exit date? Is this a good position still? What do I need to do to doctor it up, or do I need to take it all off and completely move it? Are there enough days left? So there is a lot of trader choice in this trade, but it is a lot simpler to look at with just a single tranche. But like for instance, in this case, it's 2 tranches, but they're all in the same strikes. So in this case, in 2 days, the market moved up from 1161 to 1194. I already got rid of all my calls. Well, if it continued up, let's say it continued up to let's say 12, 6 or something like that, I'm only up 1%, but it's only been 3 days. I would just take the whole thing off and completely reposition it. So it's like, okay, great. I got a few $100 out of it, and I'm repositioning the whole trade, and then I deal with that whole trade as a whole new trade. So sometimes that happens, and I end up doing 2 trades, 2 completely separate trades in the same cycle, one that's been completely taken off. So that happens occasionally.
Okay, well, I think we're getting close to an hour, but before we go, we do want to announce that Amy is starting a service where you can follow her trades live, and I've got a link in the chat that'll describe it a little bit more. And Amy's going to give a 15-day free trial to anybody who wants to try this. Now,
Do you want to share your screen, Tom? Because I just unshared mine, so I didn't know if you wanted to show them something. Oh, you have a link. Sorry.
I put the link in the chat, but I can also show the screen too. But just real quickly, it's similar to what you did with shared and mentoring with a signal service. And maybe you can talk a little bit about your plans as far as how often there's signals. You're talking about some regular videos to update the people who subscribe, to tell them what the trades are doing, that kind of stuff.
Actually, and there's I think that link that you sent them kind of talks about, that'll give you, that link that he sent you will give you a write-up about everything that's included, and what to expect and stuff like that. But basically, it's going to be a trade alert service. It'll be a single tranche Russell 2000 in a Reg T account, and what will be included will be kind of like, there'll be a video of an overview of the trade, like the basic setup, adjustments, strategies, that kind of thing, some basic thing. You'll get live trade signals for that, and as you can see, that every month is different depending on what's going on. So anytime I make a trade, immediately as that trade is filled, you'll get a trade signal that says, hey, this is the trade. I might also include stuff like, this is the trigger point that I'm looking for as well. So you'll get a live SMS and email, or one or the other, depending on what you sign up for. I mean, depending on if you have a SMS service or whatever, or you could just get them through email, but you'll get it right away. And that'll be, any trade that has to do with that particular position. So the entry, any adjustment, and exit. And then every week I'm going to do like a short little video clip to recap where that particular trade is for the week, and kind of what I'm expecting or what I'm looking for in the next week. So that'll just be a short little video that'll be included that you can go to on the class page. And then every time a trade or position is closed out, I'll do a live WebEx where you can join and ask questions about that particular trade, or you can post them ahead of time so I can include it in the videos, either the weekly videos or the recap of the trade. And then it'll also be put in the library of the class page, so you can look at it if you can't join live. And then and then go on to the next cycle. So it's just going to be for the Weirdor strategy. I am thinking about doing like more of an intense workshop on the Weirdor as well as doing some high probability nested condor trade signal service as well. This is kind of new, and Capital Discussions is kind of just starting this thing, so I just thought, well, let's just start with one thing and see how it goes. So if you guys are interested, there's a 15-day free trial, and follow the link, and hopefully it's something that you can get a lot out of. So it's a fun trade, but it definitely there's lots of little moving parts. So
yeah, I just wanted to make sure people understood that this is what Amy is actually trading right now. So the high prob Iron Condor, you're just kind of keeping track of it, but you're actually trading the Weirdor, and this trade alert service is going to mimic your live trades that you're actually doing in the market.
Yeah, it'll be because I in my live, just full disclosure, my live trading accounts, I do portfolio margin and Reg T, but I also have multiple tranches. And as you can see with that particular trade, it's different. It gets a little more confusing as far as for learning purposes of how the trade works if there's multiple tranches and if they're scaled into. So for purposes of this, I'm going to emulate the live trades I do, but I'm only going to do a single tranche. So you just have the one strike prices to worry about. So they will follow my live trades, exactly what I'm doing, but occasionally it might come up, be off a little bit because I'm not scaling in and doing multiple tranches for the class. So so anyway, if you guys have any questions on that, I think all the information is on the site. I can't see the questions, so.
Let me see if there's any questions. It's going to be $119 a month or $300 a quarter. But again, there's 15 days to try it out, and Amy's getting ready to close down this trade and start the next one. So this is actually a pretty good time to start a 15-day trial so you can get in at the start of the next trade.
Yeah, so it'll be starting February 1st officially, so it's like on Sunday. And there will be some intro videos on the site, and I don't know. I guess you can just show like where they would go to do that. So, well, I guess you already did because you have a link here. But I'll, kind of explain how it works. And your 15-day trial wouldn't start until February 1st because that's the first day of the class. In the meantime, if you do decide if you want to go there now and sign up, it won't. Again, your 15-day trial won't start until February 1st. But you can sign up now if you're interested. And if you do, you might see a couple test SMS and test emails just to make sure everything's working properly. So anyway, anything you want to add, Tom?
I think that should do it. I don't think there's any more questions. So thanks again, Amy. Thanks everyone for staying all the way to the end. We really appreciate your time, and hope you, if you're interested in Amy's trays and the Weirdors, that you take advantage of this 15-day free trial, because it's a pretty good deal to watch Amy and see how she's trading in real time.
Great. Well, thanks, Tom, for having me on and for allowing me to do this on your site. So it should be fun. I'm looking forward to it.
Okay, thanks everyone, and we'll get the replay up as soon as we can.
All right. Thanks, Tom. Bye-bye.
Thanks. All right, bye-bye.